So we now begin with a very important review that forms a part of financial markets and products, that is called derivatives. Within derivatives, we will today specifically talk about currency, commodity and stock forwards and futures. So as the name suggests, a derivative is any instrument that derives its value from an underlying. That underlying can be any asset or any instrument. So the underlying can be a book, the underlying can be a stock, it can be any asset. We will concentrate more on financial assets, however it needn't be the case. A derivative can be written and can be structured on any asset. Now the first kind of derivatives that we will focus on are called forwards. So a forward contract is an agreement between two counterparties to exchange an asset at a pre-decided price, very important, at a pre-decided date in the future. Now let's assume there are two individuals. There is individual A and there is individual B. Individual A is currently reading a book and wants to purchase this book 6 months later. So he wants to buy 6 months later. That's when he will start reading the book. Individual B will finish reading the book 6 months later. So he will finish the book, hence he will want to sell the book 6 months later. So these are our two counterparties and this is the underlying, or we are discussing a derivative written on a book or a forward contract written on a book. Let's say the current price of the book is $100 and both counterparty A, that is the buyer, and the counterparty B, that is the seller, are okay with this price. That is the current price at t equal to 0, that is right now. However, do they want to buy and sell the book today? When do they want to exchange the book? 6 months later or at t equal to 0.5? At t equal to 0.5, what is going to be the price of the book? We don't know. What is A's risk? A's risk is the price will go up because he wants to buy the book 6 months later. What is B's risk? B's risk is that the price will go down. Hence, both of them enter into a contract today. So please note, they don't exchange the book. They just enter into a contract that 6 months later A will buy the book for $100 and B will sell the book for $100 because both of them were okay with the current price, but they didn't needed the book right now. They needed it 6 months later. This guy will start reading it 6 months later. He will finish the book and that's when he will want to sell. Now please note, at t equal to 0, nothing is exchanged. No money exchanged. At t equal to 0.5, necessarily, or A has to buy and B has to sell. Please understand, a forward contract is a right as well as an obligation. So he has the right to buy and he will have to buy at $100. B has the right to sell because of this contract and he has to sell to A for $100. So forward contract is a right as well as an obligation for both counterparties. They must follow this. So that's the basic understanding of a forward contract. Please understand, it is a contract to exchange an asset in the future. Today, it is only a agreement or it is only a contract. Now, A will said to be the buyer in the contract, or he will be called the long counterparty. B is said to be the seller in the contract. He will be called the short counterparty. Please note, strictly speaking, A is not buying it today. A will buy it 6 months later. So we will say he is entering the contract as a long, because today neither of them pays or receives anything. So he say he is entering long and B is entering the contract short. That is 6 months later, B will deliver the book and receive a price of $100. Now the application that we discussed for a forward contract is called a hedging application. So are both A and B hedging their requirement or protecting their risk? Yes, A needs to buy the book and he is protecting the risk that the price may go up. B needs to sell the book and he is also protecting the risk that the price may go down. So these applications are called hedging applications. These are the first type of participants in the market. People who have an asset whose value can go down, or who require something whose value can go up, and hence they are present in the forwards market or the stock market. A could have entered this contract just for speculation also. A thinks that the price of the book will go up. He has no business in the book. He doesn't even want to read it. But he just thinks that the price will go up so that he will be able to sell it to somebody else at a higher price 6 months later. With such a view, can A still enter this contract? Because if the price of the book goes up, then B still has to sell him for $100 at T equal to 6 months. That is the contract. So he will buy at $100 and sell it for higher price if the price goes up. So that kind of an intention is referred to as speculation. So forward contracts may not just be entered by hedgers, they can be also entered by speculators who just want to profit from the gain. Similarly, B could be a speculator. He feels the price will go down. That is, he is contracting to sell at $100, and 6 months when they come and the time to sell comes, he will be able to buy it for a lower price because the price will go down. So that kind of a view may also make you enter a forward contract. The third category of participants are referred to as arbitrages, and with time we will explain in more detail what arbitrage is and how arbitrages hope to make money. In a spot transaction, you pay $100 right now and you receive the book. So everything happens at P equal to 0. This would be called a spot transaction. A forward transaction is what we just discussed. That is, no exchange happens today. It is just a contract to exchange the book in the future. We will talk about stocks and more advanced assets. For explanation, we took the example of a book. The party long is going to be the buyer of the asset. The party short has to deliver the asset and receive the pre-decided price. Please note, price is decided at T equal to 0 only. It may be decided for a future date. That date is also decided, as well as the price is decided at T equal to 0 in a forward contract. We understood what hedgers are, speculators are, and we will see what arbitrageurs are going forward. Some terminology that is used in the curriculum and used in most books. T will be referred to as the current time, that is small t. Capital T will be the time of delivery. Tau is the time to maturity, that is capital T minus small t. Sometimes we refer to as small t also as time to maturity. You will understand from the application, not very important. S is the spot price of the asset. That is the current price of the asset. FTT will be the current forward price of the asset for delivery at T. In our example, both were the same. We said that the current price of the book is also $100. That is, price at S0 for the book is equal to $100. The forward price today, the forward price is decided today, but the delivery is happening 6 months later, is also $100. So we said that they will exchange the book for a price of $100 at t equal to 6 months. So this will be called the strike price of the forward. Sometimes we write it as K, or we will write it as the forward price decided today for a delivery at a time t, that is 0.5 months or 6 months from now. VT is the value of the contract. This basically tells us that how much is either counterparty in the money or out of the money. That is, how much money are they making on the contract. Let's say we entered the contract, the same example that we discussed. Counterparty A will long the book and counterparty B is short the book at a price of $100 6 months later. Now 3 months have passed. So t equal to 0 we entered the contract, t equal to 6 the contract will mature. At t equal to 3, let's assume the price of the book becomes $120. Is it possible that 3 months later the price of the book goes up? It could have gone up, it could have gone down, it could have remained the same. Prices of assets will keep changing. It doesn't matter what kind of contract you have entered, the price of the asset will be determined by the fundamentals of the asset. If there's short supply of the book and the book is catching popularity, yes, the price of the book will go up. In such a scenario, we haven't yet reached t equal to 6. So the exchange is not yet due at $100. However, who do we think looks like he's gaining? If 3 months later the price has become $120, it looks like A is winning, or A's view is going right, because he longed the book at $100. He will likely be able to sell it now at a higher price. How much is he in the money or how much is he gaining is referred to as the value of the contract, that we will learn and we will see how it gets derived. R is the risk-free rate, and that is a very important component that will go into the valuation. N is the quantity or the number of units in the contract. This also we will study with an example. So let's understand how a forwards contract gets settled. So at t equal to 0, we entered the contract which was to exchange the book for a price of $100. And let's say we have reached t equal to 6. And at t equal to 6, the actual spot price of the book has gone up to $130. At t equal to 0, this price was $100. The contract was for 6 months. So at t equal to 6 months, this contract will have to get settled. A was the buyer. So A will now pay $100 and receive the book. As far as B is concerned, he will receive $100 and deliver the book, because that was the contract. Now after A receives the book, he, if he chooses, can sell it in the market for $130 and realize a profit of $30 at T equal to 6. This kind of a settlement is called physical delivery, where A pays $100 and receives the book, B receives $100 and delivers the book. Now let's assume that both of them were speculators. They didn't have any interest in the book. They were just punting on the price of the book. A thought price will go up and hence he entered the contract. His view went right, so he's in the money. B thought price of the book will go down and that is why he was punting by entering the contract short. His view went wrong, and let's assume that both of them are settling the contract by buying from the market or selling into the market. So after this step, A sells the book in the market. So he will sell it for how much? $130 now. That is, A will have a total profit equal to $30 and B never had any book. He entered the contract to profit from the downturn. So to deliver the book, he will have to buy the book from the market. His hope was that he will be able to buy it for a cheaper price and sell it at $100 if the price went down. But now he will have to buy the book at $130 because that is the price of the book. So he will buy at 130 and deliver at 100, thereby making a loss equal to minus $30, or a loss of $30 or a profit of minus $30. So remember, derivatives, all types, are always a zero-sum game. One counterparty's profit is going to be exactly equal to another counterparty's loss. In this case, A gains $30. Who will going to give him this gain? It has to be counterparty B. There is nobody else involved in the contract. So B loses $30. In a cash settlement, what they do is, instead of going through this whole rigmarole of delivering the asset and then he's selling it himself and he buying the asset, they simply exchange $30. So A receives $30 and B pays $30. Had the stock price ended at $70 instead of $130, that is, at maturity we entered the contract at $100. At the maturity of the contract, we see that the spot price is $70. In such a case, A still will buy for $100. It is a right as well as an obligation. So A pays $100 and when he sells it in the market, he will be able to recover only $70, thereby making a loss of $30. B will sell it for $100 and he will be able to buy it from the market for $70, thereby making a profit of $30. So who will be in a profit or in a loss? To begin with, we don't know. To begin with, the value of a contract is always zero. That is, nobody is in a profit or a loss. As time passes and the value of the book changes or the value of the asset changes, one party can be in the money and another party will be out of the money. The diagram that you see below is the payoff for the long counterparty in a forward or in the forward that we discussed. If the price of the book remains at $100, which of the counterparty gains? So there is no profit, no loss for either the long or the short. If the price ends at $120, the long party will gain to the extent of $20. He will buy for 100 and sell for 120. If the stock ends up at $80, the long counterparty will lose $20. He will buy for 100 because this is an obligation and he will sell at 80, thereby making a loss of $20. So this is how the payoff happens at expiration of the contract. We now move on to a very important concept of valuing a forward contract. That is, in our example, the price of the book today was $100, and we said that 6 months later also both counterparties enter to exchange the book for a price of $100. Now this needn't be the case. This price is decided today. No doubt it will be based on this $100 only. So whatever price we agree on will be based on today's price. However, what exactly will be the futures price or the stock price, we will now try to derive. The principle that we apply in all derivatives valuation, rather you can argue in all valuation of any type, is called the no arbitrage pricing. No arbitrage pricing simply says that similar things or same assets should have the same price. Otherwise, there will be an arbitrage opportunity. Now, let's assume that potatoes per kg were selling for $100 in New York, and the same price for similar potatoes was $200 per kg in New Jersey. Then this is an example of an arbitrage opportunity. In an arbitrage situation, there is a possibility of making riskless profit. That is, you are making a profit without any investment of your own. So in a situation like this, the way to exploit the arbitrage would be to buy potatoes in New York and sell them in New Jersey. The difference is $100 per kg, so there's a huge profit that you can make. Please note, to buy these potatoes, the arbitrager doesn't bring in his own money. He will just borrow from a bank, buy the potatoes, sell them in New Jersey, recover the money, pay off the bank back, and realize his profit. So this is an arbitrage opportunity. Theory argues that this kind of a situation doesn't exist in the market perpetually. As people buy more and more from New York, the prices in New York will go up, and as they sell more and more in New Jersey, the prices in New Jersey will go down, bringing the parity or extinguishing the arbitrage that is present in this market. So we will apply a similar concept for pricing derivatives. Concept is simple: same assets should have the same price. Now let's come back to our example. We will use the terms more generally now so that we can prove a general formula. So at t equal to 0, we will say that the price of the asset is equal to S. That is the spot price at t equal to 0. We are pricing the contract for t equal to t, that is, at t equal to 0, we are entering a contract to exchange the asset at t equal to t. The forward price today, that is, the forward price is decided today for a time t in the future is what we are trying to derive. We will also call it the strike price K, or the exercise price of the forward. That is, they decided on this price today itself. However, the exchange will happen at a time t equal to t. In our previous example, this was $100, and K also we assumed would be equal to $100. Now we will actually derive that if S0 is $100, what should be the fair value of K, or what should be the fair price that these two counterparties will agree upon at t equal to 0 for an exchange at t equal to T. The risk-free rate is given to be R. Now let's first understand the buyer's perspective, or the perspective of the long counterparty. Now the individual who is long the contract, that is who will buy this asset at T equal to T, has two options. He needs the asset at this point in time, that's why he's longing it. What he can rather do is just buy the asset in the spot, that is buy it today. We know he doesn't need the asset today, but in the worst case, if there is no forward contract available to him and he really needs the asset at T equal to T, he always has the option to just buy it today and keep it with himself till T equal to T. If he buys the asset today, that is buys it in the spot market, he will have to pay a price equal to S0 and he will receive the asset. Or this is what will happen at T equal to 0. At T equal to T, that is at expiration, he still has the asset with him, but assuming he funded this price because he didn't have any money today, that's why he wanted the forward. If he funded this S0 with a borrowing from a bank, then at T equal to T, he will have to further pay S0 e to the power RT back to the bank. S0 is the principal and S0 e raised to the power RT is principal plus interest. So we assume that he got S0 from a bank such that at maturity he pays S0 e raised to power RT and he still has the asset with him. That's what he could do if there was no forward agreement available. So buy it today and keep it with you till time T equal to T. But if there is a forward agreement or a forward contract available, that is, you can purchase the asset at T equal to T for a price equal to K, this price. In such a scenario, what will be the exchange at T equal to 0? How much will you have to pay? He's just entered the forward contract. There will be no exchange because this is an agreement for an exchange in the future. At T equal to T, in this scenario, that is when maturity of the contract comes, what will be the exchange for the buyer? He will receive the asset. It's an obligation. It's a right as well as an obligation. But he will have to pay an amount equal to K, that is what they agreed upon. So he pays K. Please note, cash outflows from our portfolio will be represented as negative. Cash inflows, we will represent them as positive. So he pays K and he receives the asset. And here he pays S0 e raised to power RT and receives the asset. So in both cases, he has received the asset. In the first case, he borrowed from the bank and funded it. In the second case, he entered the forward contract. Now, if K is greater than S0 e raised to the power RT, in the first case, effectively how much is he paying for the asset? S0 e raised to power RT. In the second case, how much is he paying for the asset? K. The buyer will say, I am happy to enter the forward contract with you. Today's price is S0. I am happy to enter the forward contract because I need the asset. But if today's price is 100, then you cannot charge me $1,000 for the asset. If today's price is 100, we will agree on a price near about this. If the price is greater than S e raised to the power RT, will the buyer enter this contract? He'll say, no, I will just buy it today. I will take a loan from a bank and buy the asset right now. So remember, for the buyer's perspective, the price has to be less than or equal to S e raised to the power RT. This is a forward contract where the asset pays no dividends. Okay, so there is no inflows or there is no income coming from the asset. Never mind that, we'll understand in more detail. But understand, from the buyer's perspective, the strike price has to be less than or equal to k e raised to the power RT. Similarly, we will now try to understand the seller's perspective, and let's see what he will think about this contract. Take out your notebooks and try to do the seller's perspective for me. So let's now understand the seller's perspective on the forward contract. At t equal to 0, the spot price is S0. At t equal to t, the counterparties have agreed at a price F0 t, which we are also representing at k. Now the seller also has the same two options that the buyer had. He can sell the asset right now in the spot market. If he sells the asset right now, he will deliver the asset and receive a price equal to S0. That is, at t equal to t, if he invests this S0 in a bank, he would have still lost the asset and he would have with him a value equal to S0 e raised to power RT. That is, if he just sold the asset right now, there is no forward contract that he entered. If however he enters the forward, then what will be the exchange today? Nothing, because it is just an agreement that they will exchange the asset at t equal to t or at a time t in the future. So if he enters the forward contract, then at t equal to t, he will again deliver the asset and he will receive now a price equal to k. That's the second option, that is in the forward. In both cases, he has lost the asset. He doesn't have the asset with him. In the first case, he has with him S0 e raised to power RT because he received S0 and he put that money in a bank. In the second case, he has an amount with him equal to k. Now, from the seller's perspective, if k is anything less than S0 e raised to the power RT, will he enter the contract? He'll say, why should I enter into a forward contract with you? I'll just sell it in the spot. I'm getting more money that way. So from the seller's perspective, the strike price has to be greater than or equal to S0 e raised to power RT. From the buyer's perspective, we just proved that k has to be less than or equal to S0 e raised to power RT. Hence, the only price at which both the buyer as well as the seller will agree is a price equal to S0 e raised to the power RT. A very important formula you must remember. People mug up this formula and go, you now know the thinking and the reasoning behind the formula as well. So the fair forward price at any point in time is going to be pretty close to the spot price. So when our book was worth $100, the forward also will be pretty close to 100 because e raised to power RT will not be that big of a difference. It will be close to 100, but exactly it will be given as S0 e raised to the power RT. This is called the no arbitrage price of a forward contract. The price of the forward cannot be any different from this. If it is, then there will be an arbitrage opportunity, and we will study in today's session how to exploit that arbitrage and how to make money if you see in the market that the forward price is different from S0 e raised to the power RT. We will understand it better with more examples. However, we understand the concept for now as to how the fair forward price is derived in the future, or you can say S is F e raised to power minus RT. If I just bring S e raised to power RT, e raised to power RT on this side. We will bring in a slight complication into the matter now. So we are again trying to price a forward contract. The price today or the spot price is S0. We are valuing the contract at t equal to t. However, Now it is known that the asset will pay a dividend equal to D. So the tough part of forwards and futures is over. The pricing and the conceptual thinking behind futures contracts in any market is exactly the same as what we have studied for forwards. Only futures are more standardized concepts, and the slight difference between forwards and futures we will study next. So we entered into the forward contract. The agreed upon price was $100. So at t equal to 1, I will buy and pay 100, and the seller will receive 100 and deliver the product. Let's say the price of product at maturity is 200 and the seller simply runs away. That is, when the time of delivery came at t equal to 1, he was just not there to honor his obligation. So I didn't buy at 100, I actually had to pay 200 to buy it. Is this a risk in forward contracts? It definitely is. So forward contracts per se are called OTC contracts, or over the counter contracts. That is, two counterparties are entering into an agreement, and yes, the judicial system should help them in the enforcement of that contract, but if somebody reneges, then for $100 it will be tough to get into the whole legal process to recover your money. Hence, what we can do, or what exchanges do, is they standardize these contracts and help investors from this credit risk, or this risk of one party reneging on its obligation, by defining something called as futures contracts. So futures contracts trade on organized exchanges. They are not over the counter contracts. Now what these exchanges do is they standardize the performance or the delivery of the contract. For stocks and bonds, it's not a big issue because anyways the contract is in an electronic format. But in the case of commodities, standardization becomes a big problem. So let's say I bought 100 kgs of rice, and when the time of delivery comes, there would be disagreement upon the quality of rice, and two counterparties may not agree on what was agreed upon and what is being delivered. So the exchange ensures that what is the definition of the product, or 100 shares or 100 lots of this stock, or 100 kgs of a particular quality of rice, so that both buyer and seller are assured that they have to deliver a given quality and the buyer will receive a given quality. Very importantly, exchanges maintain something called as a clearinghouse. So when two counterparties enter a futures contract, let's say one agreed to buy the asset for $100 and the seller agreed to sell the asset for $100. To begin with, nobody is in the money or out of the money, because the value of the contract, please remember, we derived as S minus K e raised to power minus RT. To begin with, K is the same as S e raised to power RT. The strike price or the forward price is defined as S e raised to power RT, or the value of the contract would be S minus S, that is 0. So to begin with, when the spot price is the same as S0 and the forward price is S0 e raised to power RT, there is nobody who is in the money or out of the money, otherwise there will be an arbitrage opportunity. As time passes, if 100 becomes 200, buyer is in the money. If 100 becomes 10, seller is in the money. One counterparty can be in the money or out of the money. Now what an exchange does is that even though nobody is in the money or out of the money, both of them will have to deposit something called as initial margin, which is, for example, 20% of the value of the contract. So even though nobody is in the money, both of them will have to put in $20 with the exchange. This is done to ensure that if one counterparty is in a loss, the exchange can itself cash settle the contract because it has a margin from both counterparties, so he can just take $10 from here and give it to the other counterparty if the other counterparty is in a gain and this one is in a loss. So even if he runs away, there's no problem. And then the exchange marks to market the contract every day. So every day now the S will change. Our K has already been fixed. So the spot price will change and hence the value of the contract will keep changing. If the value of the contract moves such that counterparty A or the seller has a loss of $15, then what is his remaining margin with the exchange? Only $5, because $15 already is in a loss. If S went up, for example, seller would be in a loss. What the exchange would do is now ask him to pay up more margin, so that if he goes into a $15 loss further, then there is money with the exchange. And if he refuses to pay that margin, if he refuses to pay the other $10, the exchange will simply square off the contract. So he will long it, return his $5 and pay the $15 to the long counterparty. So both the buyer and the seller don't see each other in a futures contract. For them, the counterparty is only the exchange. For the buyer also the exchange, and for the seller also the exchange is the counterparty. So there is an initial margin that everybody has to put up, and there is a maintenance margin, for example $10. So if 20 becomes 19 because of a $1 loss, exchange won't bother you. Till $11, $12 also if you have margin, that's fine. Exchange will see the daily fluctuation that normally happens in the stock and then decide the margin amount. So if the volatility is not much, then a 10% maintenance margin is what the exchange has decided. That is, when your position goes below $10, so if you have a loss of $11 and this 20 becomes $9, then you will have to top up, or you will have to put up more margin to bring your balance back to the initial margin. So you'll have to in one shot pay $11 more and bring it back to $20. So that's how futures are standardized contracts with no credit risk, because the exchange has a clearinghouse that keeps this margining, and then it marks to market the value of the contract daily by the process of S minus K raised to power minus RT. Then on futures, a lot of data is available. In an over-the-counter contract, if me and you are entering into a contract, the whole world doesn't know about it. But in a futures contract, the whole world does know, because the exchange publishes the volumes and the open interest every day. Open interest is how many long contracts are outstanding in any particular day, which will be the same as how many short contracts are outstanding, because for every long there has to be a short. This is the total number of contracts outstanding, the open interest, and the total trade or the total volume that happened. So a lot of analysis can be done with futures and data from the futures markets. So an investor enters into a short position in a gold futures contract at USD 294.2. Each futures contract controls 100 troy ounces. The initial margin is USD 3,200 and the maintenance margin is USD 2,900. At the end of the first day, the futures price drops to 286.6. Which of the following is the amount of variation margin at the end of the day? So variation margin is the difference that needs to be paid to bring the balance back up to initial margin. Please solve. So he short the contract at 294.2. and now the value of the contract or the price has dropped to 286.6. So what is his loss? Please note guys, this is a trick question. He is in a short position, so he is selling at 294.2, and if the price falls, it's very good for him. He'll buy it at 286.6. He actually has a gain on each troy ounce of 294.2 minus 286.6. If we changed this question to a long position, then there would be a loss of this amount. Right now, there is no margin required. In fact, he can withdraw some margin. That is, his position has gained. So he has to keep only 20%. Some margin can be used for other investments. If it was a long position, however, there would have been a loss of 7.6 per troy ounce. For 100 troy ounces, it would have been 760. 760 would have made the value of his position from 3200 to 3200 minus 760, which is 2440. 2440 is less than 2900. Hence, the margin call would have been triggered, and he would have had to put enough margin to bring it back up to 3200. That is the initial margin. So he would have had to pay another 760 only if it was a long. In a short, there would be no margin required. In fact, he can withdraw $760. That is the gain that he has. Which of the following statements is incorrect regarding the margining of exchange traded futures contracts? So day trades and spread transactions require lower margin levels. That is correct, because these transactions will have lesser fluctuation. The exchange keeps a margin so as to cover one day's maximum loss, because at the end of the day anyways it's mark to marketing and new margin is being asked for. So in one day, if the loss is more than 20%, only then there is a credit risk, because up till 20% movement he has already kept margin. So in spread transactions where you are buying as well as selling, the fluctuations are not as high. Hence, exchange may choose to keep a lower margin than for general long or short positions. If an investor fails to deposit variation margin in a timely manner, the positions may be liquidated by the carrying broker. That is correct. Initial margin is the amount of money that must be deposited when a contract is opened. That is correct. A margin call will be issued only if the investor's margin account balance becomes negative. That is incorrect. Whenever it goes below the maintenance margin, a margin call will be triggered. So it doesn't have to become negative. So D is the incorrect statement and the right answer in this case.